Hello, in this video, we'll be going through the perpetual versus periodic inventory systems transactions. Quick recap for the difference between perpetual and periodic inventory system is that the perpetual inventory system continually adjusts the inventory and the cost of goods sold account each time there's a purchase, a sale, or return of inventory, depending on which account it affects. So think of the technology of going into a store and they scan an item that they sell, it automatically updates the inventory to be less of that item. And so anytime something's purchased, they scan it in and it updates their inventory. So they always know how much inventory they have on hand and what the cost of goods sold for their inventory sold is. In a periodic inventory system, the inventory account and the cost of goods sold are only adjusted at the end of a reporting period, hence the name periodic inventory system. And so during that period, whatever period that time it is, when they acquire inventory or get returns, they record them to these temporary accounts, such as merchandise purchases, purchase returns, purchase discount, and freight in for the transportation costs. However, the formula to calculate cost of goods sold is the same under the perpetual or the periodic inventory, which is beginning inventory plus net purchases minus ending inventory equals cost of goods sold. I will say the beginning inventory and net purchases gives you the subtotal of that is the cost of goods available for sale. So, and I highlight that point because it will come up later in this recording and various other recordings. So let's go through an example of a company that made acquisitions, purchases, and returns and had discounts, and see how we record it on the perpetual, if a company is on the perpetual inventory system versus the periodic. So here's our example. The Lothridge Wholesale Beverage Company purchases soft drinks from producers and then sells them to retailers. The company began the year with inventory of $120,000 on hand, and during the year, additional inventory transactions were as follows. We're going to go through the slides one by one, so I'm not going to read it. Okay, number one was that they purchased inventory on account totaling $620,000 with terms 2, 10, and 30, which means if they pay it, which means they get 2% discount if they pay it within 10 days, otherwise they owe the full amount within 30. So under the perpetual system, which is what most companies these days have, when we acquire inventory, it's just debit inventory, credit accounts payable for the $620,000. Under the periodic system, we do not update our inventory and cost of goods sold until the end of the period. Instead, we use these temporary accounts. And instead of inventory, we use this temporary account called purchases. So we debit purchases 620, credit accounts payable 620. Number two is freight charges paid by Lothridge, and that's the buyer, were $16,000. It doesn't tell us this, but this is FOB shipping, which means the inventory belongs to the buyer as soon as they are shipped, and that's what we assume here. And freight charges are the transportation costs incurred to ship the product from the seller to the buyer. So perpetual system, we debit inventory, we increase our inventory by $16,000, and we credit cash, assuming we pay cash. And then under the periodic, we use this temporary account called freight in for $16,000, and then the cash $16,000. This purchases and this freight in will all be eventually included in the inventory account. So at the end of the day, we will get to the same place as the perpetual system. Number three, Inventory with a cost of $20,000 was returned to suppliers for credit. So here we bought $620,000 worth of inventory on account, and so now we returned $20,000. So here we go to number 3. We're going to debit our accounts payable 20 because here we credited 620. So we're going to debit the accounts payable on both sides, whether it's perpetual or periodic, 20, because we're returning it, so we no longer owe that 20. And so under the perpetual, here I'm going to credit my inventory because I had debited my inventory originally. And under the periodic, I'm going to credit this temporary account called purchase returns, which is just reduces the purchases and therefore reduces inventory. And then we have number 4 is all purchases on account were paid within the discount period. So remember the discount period was 2% for if it was paid within 10 days. However, when we bought the inventory, we bought 620,000, but then on item number 3, we returned 20,000. So we have to reduce this amount by 20,000. So our accounts payable now balance is only 600,000, and we look at this, that's what we get a discount on. We get a discount of 2% on the 600,000, which equals 12,000. Okay, so let's see what that entry is. Number 4, that's where we're at right here. Now I'm going to reduce my accounts payable by 600, right? Because I credited 620, debited 20, so I have a credit of 600. So I'm going to debit my accounts payable 600 either way, whether it's periodic or perpetual. Okay, let's go back to the perpetual. I paid $588 because I got a $12 discount by paying it early. So my cash outlay is $588. Same thing in the periodic system. Your cash outlay is it is what it is. It's your cash outlay. This is the only difference where we recorded difference between the perpetual and the periodic. So in the perpetual, we're going to reduce our inventory account by that discount amount, that $12. And under the periodic, I have another temporary account called purchase discounts, and that's where my $12 goes. So now seeing the periodic, I have my original purchases, I have purchase returns and purchase discounts. And freight in is also part of the purchases. Net total purchases, total, it will be. Number 5, oh, this should say number 5. Number 5 is sales on account totaled $830,000 and the cost of soft drinks sold was $550,000. So let's record our sale. We credit sales revenue $800,000 and debit accounts receivable because it was on account, so they didn't pay us cash. It's the same thing for the perpetual versus periodic. A sale is a sale. However, with the perpetual system, every time we make a sale, we adjust our inventory and cost of goods sold. So we reduced, they told us that the cost of that inventory that we sold, we paid for it $550,000. So we're going to reduce inventory by $550,000 and we're going to debit cost of goods sold at $550,000. Now this is a big difference between perpetual and periodic. See, periodic has no entry, and that is because they only adjust their inventory and cost of goods sold at the end of the period, not every single time an inventory is sold, if not every single time that the company makes a sale. And then number 6, it tells us that the inventory remaining on hand at the end of the year was $174,000. Okay, so you'll see why we need that. For the periodic inventory system, we have to calculate the cost of goods sold at the end of the period versus for the perpetual, it was given to us. And so the way we do that, remember our formula, we take our beginning inventory plus our net purchases. So it tells us that the problem told us that our beginning inventory was 120,000. And then we go, our net purchases was everything affecting the purchase account. this temporary purchase account. And that is the purchases, and that's just based off the entries throughout this video. We purchased $620,000, and then we had freight in of $16,000. These were both debits, right? These were debits to these accounts. And then we returned $20,000, and then we paid early, so we got a discount. So these were credits to the purchases account. So we add those in, we add these in, and we subtract these out. And so we take our beginning inventory plus our net purchases, which is the sum of all these four, which subtotals to 604. So we take our beginning inventory plus our net purchases is 604. So the total net purchases amount is right here, 604, to give us this subtotal of cost of goods available for sale for $724,000. So we take our formula is beginning inventory plus net purchases minus ending inventory. So that's why we have less. The problem tells us that our ending inventory is 174, and so therefore our cost of goods sold is $550,000. And I want you, this perpetual side didn't change from the previous slide. We had already booked cost of goods sold for $550,000 under the perpetual system as soon as we made the sale. Under the periodic, we had no entry. So this is what we're doing now. And we have to close out all these temporary accounts. So I'll like put a little check by all the little temporary accounts, right? So we had a debit for purchases and freight in for these for 620.16. So now we have to do a credit to close them out. And then we had a credit for purchase returns and discounts. If I go back here, you see these 20 and the 12 were credits to those accounts. So now we're going to debit those accounts by 20 and the 12. And we're going to credit the beginning inventory account of 120. But we're going to debit, they told us our ending inventory was 174, and we're going to debit the ending inventory for 174, and our cost of goods sold is 550. Just want to quickly look at the, if I look at the inventory, actually, I'll redraw this. If I look at my inventory, and I look at, let's just say my net purchases, I'm just going to look at the total net purchases here. My beginning inventory was 120. And my net purchases, I had a debit of 620, and I had 16, and I had a credit of 20 and a credit of 12. Okay, that was all the previous, and then I added, yeah, that was it. And so these were my total previous entries. And so then now if I'm going to, let's just say, let's see if I can change this color, record this entry right here, just focusing on the inventory net purchases. Well, here I have a purchase return for 20. So I'm going to have a debit for 20. Purchase discounts debit 12 to 12. Credit purchases 620. So I'm going to credit 620 and freight in for 16. And then I have a debit inventory, ending inventory is 174. But I also have a credit right here to beginning inventory for 120. So if I look at all of those subtotals, this crosses out. So my ending inventory is 174. And these all cross out. So it's 0. And that makes sense because these are all temporary accounts, which means they zero at the end of every period. So I just wanted to kind of show you in a T account format what the end product of this entry is that we have $174,000 remaining in our ending inventory, and we have our cost of goods sold for $550,000, which is exactly the same as a perpetual system.